topic is managed futures as an asset class of evolution and opportunity. And our sponsor, of course, is Jefferies. I want to thank Steve McDonough for organizing the event. Steve,
a lot of new faces today. Welcome, everyone. For those of you who haven't been here before, this is our third year of bringing investors together with great money managers. I'd like specifically to welcome Trevor Keefe from Paris and Lynell. This is your first time. Welcome. And with that, stay with me.
Thank you very much. Okay, we have three pros from the futures world with us today. Let me introduce them quickly. Actually, I should start with just a quick comment to set the stage. As I walked in, one of our members here at the table said to me, very abstract art, just like the topic. And hopefully our speakers will strip away some of the abstraction and give us some feel for the palpable realities of futures. Let me first introduce Tom Schneeweiss, who's next to me. Tom is really one of the academics when it comes to futures. He's a professor of finance at the Heisenberg School of Management at the University of Massachusetts at Amherst, which is where you drove down this morning, I believe. All right, thank you very much.
A little ice up there, though.
A little ice up there. That's great. He's also the director of the Center for International Securities and Derivatives Markets at the School of Management. He is a very widely published author in the field of futures and alternative investments, having co-authored Financial Futures, Fundamental Strategies and Applications, and being the author of Benefits of Managed Futures and Alternative Investments in the Institutional Portfolio, which is published by AMA. And he's edited several books, including the Handbook of Alternative Investments and Investor's Guide, which is soon to be published by Institutional Investor. He's on the board of directors of the Managed Fund Association and editor of the Journal of Alternative Investment, which is published by Institutional Investor. And actually, I've had the pleasure of editing one of his articles for a book that I edited on hedge funds, and only found 2 typos. So thank you very much. Some of those articles had a lot of relief on them. Tom is also managing partner of TRS Associates, who specialize in multi-advisor funds, asset allocation, and risk management. Next to Tom is Richard Dennis, and if Tom is the academic in the futures arena, then Richard Dennis is got to be the trader's trader. In fact, I found a comment from Bill Eckhart, another very well-established trader, and interesting comment about Mr. Dennis, which was that he started out with only hundreds of dollars and ended up making hundreds of millions in less than 2 decades. That's quite motivating. And it certainly is. His career in the commodities industry began when he was 17 as a runner at a brokerage house, and he's now president of Dennis Trading Group, running about $300 million. And also was the originator of the legendary Trust program, which a number of you are sure must know. And also we have Vern Sedlacek, who's the president and chief operating officer of John W. Henry and Company. If Tom is the academic, and Richard is the trader's trader, and Vern's going to be the manager's manager, because he really has a grasp of what really goes on inside a sophisticated money management organization. At the KWH, Vern is which is one of the largest futures advisors in the world, with about $2.4 billion in assets. He's responsible for the day-to-day management of that firm. And before joining JWH last July, he was the executive vice president and chief financial officer of the Harvard Management Company, which at the time was managing approximately $14 billion. And he was responsible there for managing the whole area of personnel, budget, systems, performance analysis, contracts, credit compliance, custody operations, cash management, securities lending, and market risk evaluation. So we have 3 fellows here who really know top to bottom what futures is really all about.
Very good, Tom. Let me ask a couple of questions first to start out. How many actually have invested with the CPA Managed Futures, personally, professionally? Okay, fair number. Can you think of one reason, everybody in the room, who can think of one reason to invest with the CPA? Okay. Who can think of one reason not to invest with a CTA? That's it? One person? Well, as Ron said, I was with Harvard Management for 15 years, and I first became intrigued with the CTA world back in 1991. And unfortunately, I had to change my speech this morning because I promised Mr. Mayor I'd be controversial a little bit. And last weekend, I was hoping he forgot, but the first thing he said this morning was, I got off my deathbed, in my operating bed, to come in and hear you be controversial. So I had to change my speech. Let me, in terms of reasons not to invest with a CTA, I think that's one of the things we want to talk about. And obviously, it's not my best interest to list these, but I had a lot of experience of reasons not to invest with a CTA at Harvard. And as I said, I really started looking at this in 1991 and became very intrigued because it didn't seem like this asset should exist. This type of investment should exist. It had negative correlation to the stock market or low correlation to the stock market. It had, apparently positive returns over a long period of time, better than many other assets. And so, in looking at it, to say this kind of asset shouldn't exist and shouldn't exist in the market. We all understand, as Tom said, why stocks go up. We understand why small cap stock goes up. We understand why venture capital on average works. We understand to some degree why leveraged buyout funds work. And it's even hedge funds. It's kind of easy to understand. I mean, it's simple. And so when I took a look at the CTA world and tried to figure out why did it exist, why did it make money, why was it a diversifier, I have to tell you, I couldn't figure it out. I heard lots of things. I talked about CTAs. I heard lots of things about, producers pricing things and differently than hedgers and trends working and, but there's nothing that I heard that really said there's any advantage associated with the CTA. That trend following or managed futures or whatever you want to call it was something that really had, I've heard the phrase, wind behind the sails, okay? We know stocks have wind behind the sails. I mean, when the economy grows, stocks on average will grow. And we know commodities will go up and down in value based on inflation. And we know real estate, will grow, as the economy grows and demand for real estate and venture capital, et cetera. And even hedge funds, we can understand. Macro hedge funds, we can understand from the standpoint that, the macro hedge funds just have very smart people working for them, or they have, legally inside information because they're, George Soros knows the head of every, central bank in the world. And convergence, market neutral traders, we can understand, right? We can see the spreads in the market. We can say, oh, geez, this bond is priced at this price, and this bond is priced at a different price. And eventually, the world is going to become rational, and they're going to be priced closer together. But CTAs, there's no story there. And so in thinking about it, there were a whole bunch of reasons not to invest with CTAs that I had thought of. Clearly one of them was volatility. Volatility of an individual CTA seems to be huge. And if you think of CTAs as an asset class, the volatility is very low. And yes, it may be not so large relative to an individual stock or even a group of stocks, but on a standalone basis, it's still very big. Second is, why does it work? And this is the hardest thing. Why in fact, do CTAs make money? I talking to my old boss up at Harvard just a couple weeks ago, and really, we were talking about CTAs, and he said, "What is there? Some secret, in your formula that identifies something that the rest of the world can't see? Because markets are efficient, right? If markets are efficient, there's no way to make any money. And why not just buy a long straddle?" Right? I mean, you can buy a long straddle, you know how they're priced, you know what the return profile is going to be. Why do you have to wrap it in this mystery of, there's some program that exists out there that identifies these trends and there's some advantage, but we really can't tell you about it, specifically what the advantage is, because if we did, everybody would do it and we wouldn't make any money. Contrary to Tom's myth, I think there is an issue with the index out there. I mean, everyone understands the S&P index, right? Everyone understands the Russell 2000. Everyone understands a distressed index that Solomon puts out. There's lots of indices out there for managed futures. And that's part of the problem. There's the MLM, and then there's the MAR, and then there's the Hedge, and then there's, there are lots of them. So really, there's not an index. And there's not a passive index that's as clearly identified as and understood as relative to the S&P 500. Fees are an issue. I do this all the time, obviously. John Henry. Why should we pay somebody to do this? I mean, if it's just some dumb black box that's cranking out, buy and sell recommendations, and in fact, if it really exists and anybody can do it because there are trends that are out there that can be identified, as Tom says, it's really an asset class, then why should we pay somebody high fees to do it? I mean, I understand paying George Soros. I mean, he knows all central bankers, right? He gets inside information based on that. But I don't understand why I pay somebody to run a black box model. Derivatives, another big problem. It's derivatives. And derivatives, by their very nature, are bad. Okay? And therefore, they're bad because we don't necessarily understand them. They are not regulated, or they are regulated, or we don't understand the regulation. You can leverage to the hilt, and look at long-term capital, look at bearings, the list goes on and on, derivative losses. And that's another good reason not to invest. Transparency. I want to know your positions every single day, and I want to know every trade. Otherwise, I can't understand what you're doing, and I can't understand what my risk is. Well, CTAs, by and large, John Henry being one, don't want to give their positions every day. They don't want to give every trade. There's the secrets that we got to protect, right? And so, the transparency issue, and we had the issue with hedge funds, and now it's even more evident after long-term capital. Long-term capital get away with saying, we're not going to give you our positions because we've got 2 Nobel Prizes. And so we don't have to tell you our position. And so, transparency is an issue. Next, it's not really an asset class, for crying out loud. I mean, it's really an asset class. You can understand why it works, right? And you get divergence in terms of what people talk about, right? Some people say it's an asset class, which means it has an index, which means you can replicate it, relatively simply. But, the fact is, it's not an asset class. I mean, you have, the father of trend-following traders sitting next to me. I mean, he does things very differently than John Henry does. And there's, how many CPAs out there? Hundreds, thousands, right? Everyone does things a little differently. So, it's not really an asset class. Capacity, another issue. There's been a significant growth in the amount of assets under management. And eventually, whatever secrets are out there and whatever returns that we've been able to generate, in the past, are going to be arbitraged out of the market because there's going to be more players in the market. And clearly the amount of assets under management in the managed futures CTA world has grown. Next is really it's model-driven. In most cases, it's model-driven. And therefore, it's, unless we can understand what the model is and why it works, we're not going to invest. So, these are kind of the list of reasons that I think about not to invest in managed futures. And I'm sure you have some others, but hopefully I hit most of them. And I wanted to address a couple of them because obviously I've done my point, now I got to do my counterpoint. Okay. What I finally came to realize, and thanks a lot to the work that Tom and his group have done and others, is that in fact there is a real market inefficiency that exists out there, and it's captured in many different ways through many different types of trend following. And the market inefficiency is, and this somewhat flies in the face of many other views of the world, but the market inefficiency is really that human beings are fundamentally biased in their views of the world. And in fact, their views of the world in the investment business impact prices. And all I have to do is look at my own personal view of the world. And the fact is, I'll never buy a bond. I will never buy a bond because bonds do terrible in inflation. And I remember the gas lines, right? I remember when inflation was 18% or 12%. And I will never own a bond. That is my fundamental bias. I loved Russia. That's an investment vehicle and a place to invest. That's another fundamental bias. And the fact is, I make decisions based on those biases, just as everyone in this room makes investments based on this, on their bias. In George Soros' new book, I don't know if you've read it, I've read about half of it, but he seems to be a CTA. He seems to believe in the CTA world. I mean, basically he said markets are fundamentally unstable and people are fundamentally biased and invest in the market. And he gives a comparison of saying it's when we are making investment decisions, we look at the world and we can understand all of it, what's right in the middle. And when our brain builds constructs, the model around what the middle of the picture looks like. And so it's like looking at one of these pictures. I don't think my brain could probably build, at least in some of these, what the middle of the picture looks like. My biases would affect how I did that. And that, in fact, is really what I think one of the fundamental drivers of managed futures is that trends develop, not because governments intervene, trends develop because people are fundamentally biased. And I'm going to make an investment decision, whether it's Russia going down, whether it's inflation coming back, based on my own bias. And in fact, trends develop because people make those decisions. As news comes into the marketplace, people make those decisions based on that news. But their news is going to be based on past history. And so eventually, there will be a sea change in sentiment. We don't make money on every trade. Maybe Mr. Dennis does, but we don't make money on every trade. We make money on trades where the trends really come to fruition. And then maybe 4 or 5 trends a year that take place where those trends come to fruition. Where people see the Russian situation and they say, Russia doesn't look too good. All the IMF's coming in. Okay, they're going to save Russia. So, bonds are not, there's not a credit issue in Russia today. And then a little bit more news comes out, and then a little bit more news comes out. And the trend develops. And all of a sudden, the sentiment changes drastically. The world's view, their bias, their fundamental bias that exists, is overwhelmed. And sentiment changes 180 degrees, and everybody wants to buy bonds because the world is coming apart. Those are the type of trends that may be good or bad for the stock market that we and other trend-following CTAs take advantage of. They exist, and they exist because of the fundamental bias and the skill associated with the CTA, the trend-following CTA, really is in the model, the identification of the model, the discipline they apply to the model, and how they execute, right, based on the model. And so there is a factor of inefficiency in the market, a wind in the sails, which exists, and compounded by the skill level of how the model works and how it executes. And there's lots of different trend followers out there, the short-term, long-term, medium-term. It's interesting, they all seem to work. And they work during different times, which is something you would expect. In terms of volatility, yeah, we're volatile, right? The stock market's volatile, bond market's volatile. Venture capital would be volatile if they could market to market. Hedge funds would be more volatile if they could figure out how to price their positions. But that volatility is where the return is created. And what we want to be is we want to be volatile during times when other things are being volatile in the other direction. And August and September of 1998 was a perfect example of where the trend that developed in the market was fundamentally destabilizing for the stock market. And that trend and instability that took place is really where most, if not all, or certainly a large majority of trend-following CTAs made their money. And you pay for that kind of return during those periods of time because of the volatility, with the volatility that exists during other periods of time. I wanted to make a couple more comments. I think my time is running out, but I want to make a couple more comments. One of the things I was supposed to talk about today before I changed my speech after seeing one this morning was I was supposed to talk about structure, right? A couple of interesting things about CTAs and about futures in general. Right? Futures are very liquid. We all depend on liquidity. We are basically, and I've used this term before, we are basically divergence traders. We are the opposite of convergence traders. So we have a very different view of the world. We have to trade in liquid markets because of the risk management systems that most of us have in place in terms of stop losses. If we can't get out at the price that we want to get out at, we cannot generate excess returns. So we have to be in liquid markets. That liquidity creates opportunity. Secondly, it's a leveraged position. We have to put up a little amount of good faith deposit with the exchange to be able to take position. And so that creates the ability of flexibility. The third is that there's no credit differentiation. Unlike, for instance, a hedge fund, because we use good faith deposits, right? And because we use exchanges by and large for most of our transactions, there's no credit differentiation. And a CTA that has $120,000 of assets under management is basically has no different constraints than a CTA that has $2 billion under assets, which is very different from the hedge fund world. Because of that, we're able to create structures. One of the hot products, I think, in the market today is structured notes that are based on CTAs. But that's no different than any other financial engineering. It doesn't change the fundamental ability to generate returns in volatile markets. We've seen swaps out in the marketplace. Again, it's because we have the flexibility, the leverage ability, and the liquidity, we can do swaps. You see products out there where they mix S&P futures with CTAs, or they mix bonds with CTAs. Again, the interesting thing about that is when you look at it, it doesn't really change. It doesn't really change the product, the CTA product. All it's doing is mixing and matching a whole bunch of different things together, and something that sophisticated investors could do themselves without having to pay for the bundling costs and the management issues. So going back, and when I first got to JWH, we had lots of these products out there, and looking at it and thinking about it, I realized that one of the things that we need to focus on is the fact of what do CTAs do and why should they be in your portfolio, not how you can mix and match it to make it look like something that it's really not. And while sometimes you have to do that to get by boards, and sometimes you have to do that to be able to sleep at night, the fact is that with a large pool of assets that probably most of you out there have, you can mix and match yourself and keep the purity of the CTA as pure as possible. I'll ask Mr. Dennis to talk about the other few things that I didn't cover in terms of the reasons not to invest, like fees. And I'll conclude my remarks.
I'll turn to you first and give us the stage that was essential for this morning.
Well, thank you very much. I appreciate the chance to be with you this morning. I'm looking around all the art around me here. It's about as cultured as I get. We see around us a huge development here of art, from early traditional to more, we say, exotic art. And I think we have a chance to really talk to you about this kind of development inside the investment field also. I'm sorry the fact that the word academic, that's to put you all to sleep before we get to the real interesting people here. So just get a chance to get started. You don't have to listen to much. It's just an academic, Why do you have an academic here? Because the title of today's talk is, basically managed futures as an asset class. And I guess I'd like to tell all of you that we know it's an asset class. The reason you have to know it's an asset class is academics are always the last people to get into something. So we're finally there. We now have a journal, the Journal of Alternative Investments, right? So even if it wasn't an asset class before, you know what it is because we have a journal dedicated to the area. So whether you believe it or not, at least academics have finally come on board and finally came to the conclusion that alternative investments, and more importantly, managed futures, form its own asset class. One quick question. If it's such a wonderful asset class, why isn't it in all your investment books that you read and understand? To tell you the truth, if you pick up today's normal investment textbook, written in 1998, you'll see that it was written in 1996. Second edition, really written in 1994, using material and articles written in 1992, which were written using data in 1988. So you pick up the typical investment textbook today, the reason managed futures or alternative investments don't focus a major portion in today's institutional textbook market for investments is it's a relatively new area. Why is it relatively new? Well, it's relatively new because of changes in communication, changes in opportunities in the marketplace. We really have seen kind of, if you would call it, an opportunity where traders that traded primarily at institutional houses, kind of a decentralization of the trading market. So individual traders, Mr. Dennis and other individuals that trade at major proprietary trading houses now are offering their services and their products, are capable of offering their services offline to investors such as yourself. And what are these products? What are these services? and how do they fit into investors' portfolio, and what is the real source of the return to managed futures. And that's some of the things that we really analyzed up at the center. There's a lot of myths about managed futures. And one thing we want to point out is that primary myth is that what does it really provide to the investor? We like to say that an asset class or an investment is important to an investor if it provides something very unique, a unique return or risk opportunity that is simply not easily reproducible in other asset classes. Now that's our definition of an asset class. An asset class is unique in the fact that it offers a risk-return opportunity that is simply not easily affordable in other investment groups. And what academics have finally really come to realize is that managed futures, or the strategies, or the processes by which managed futures create the return process, is in fact an asset class because of that unique process. It offers a unique return opportunity not easily found in other investment vehicles. Why? Well, essentially, before I get into some of the other myths, and kind of, typical in academics, you tell the conclusion, then you tell the story, then you go back and tell the conclusion again. It certainly shouldn't surprise you that not only non-traditional assets or alternative assets such as hedge fund and managed futures, but traditional assets, as you all know in the academic community, we find styles or drivers. What drives the return to traditional assets? Well, certainly we've been doing it for 20, 30 years. Sharpe's model, 1962. After 30 or 30, 40 years, we have a pretty good idea what drives traditional assets. Either essentially changes in cash flow on the top side or reduction in risk premium, interest rates on the bottom side. And we have a fairly good idea what drives large cap growth, small cap growth. The unfortunate thing in traditional assets is what drives the most stocks and bonds, in fact, forces them in extreme market conditions all to go up together and all to go down together. So in fact, you don't get adequate diversification by being only in traditional long-only portfolios. Simply not there. And increasingly not there as firms go international and move away some of the diversification risk that once existed by having large stocks having unique positions internationally in small local areas. So a lot of the diversification benefits and a lot of the uniqueness existed in long-only stock investment vehicles over the last 5 to 10 years is decreasing. Might have been there in the 70s, might have been there in the 80s. It's less there in the 1990s and into the year 2000. Fine, we know what drives the traditional long-only investments. The style analysis, the drivers to those particular processes. What about alternative investments? In truth, there's a wide set of alternative investments, managed futures being only one of them. I'm not going to net our views here to talk about hedge funds and private equity and real estate and commodities. They're all under what we call the rubric alternative investment. Well, let's just put up the side and say a lot of those particular strategies, private equity, for instance, has the same drivers as long equity, economic growth. So a lot of academic studies have shown that a lot of the so-called alternative investments that we used to say traditional alternative investments, we used to call them travels, they have the same drivers as the long-only stock and bond area. Your private equity position makes a lot of money when your stock position makes money, in all honesty. They aren't really, they make money, nice risk-return trade-off, and that should be part of a portfolio, but it's not something unique. Its drivers are the same drivers as it drives your long-only stock and bond portfolio. What about commodities? Somewhat the same thing. In fact, if you have growth, increased demand for commodities, increased economic growth, they're somewhat correlated with one another. Not because they're correlated, we know what drives the return process, and they're the same things again. Okay? A lot of hedge funds that have long positions have the same drivers as stock bonds. So certain hedge fund strategies do not offer you unique diversification relative to long-only positions. Some hedge fund strategies might, but likewise, even a large number of hedge fund strategies have conditions where they will not offer you return in markets which have large intraday volatility, where there's a lot of uncertainty. So your spread strategies, your stat arb strategies, your long-short strategies start losing money when markets have a tendency to have an intra-period volatility increases, uncertainty. And so they have their own unique drivers. And we can't have enough time here to talk about all those drivers. What we're here today, from an academic sense, it can give you some sense of the drivers of some of the people like Richard Dennis and I'm sure that Vern are going to talk about. Essentially what academics now know is that there's these certain drivers that cause your stock and bond portfolio to increase. We know what drivers cause your hedge funds to increase or have difficult times. Over here, what are the drivers of managed futures? Well, it's not me here to speak for all of the trees. There's a lot of different strategies, and each one make their money using different ways. But essentially this. We certainly know in academics today, we have a chance to look at the past, we finally learn. We learn slowly, but I think we finally learn good. Well, that's the English part that you had to fix. That was the well. I know those red marks in there were run or something. And what we find out is that in currencies, in interest rates, government policies, or various markets, and different loss functions by individuals can cause markets to trend for the short run, and maybe even in certain cases for the long run. Currencies don't go from 180 to 120 overnight. They go down slowly because the government doesn't want them to go down fast. There's political loss. When you move interest rates, you don't move them from basically 5 to 6 overnight. You move them in quarter points for political reasons. And so essentially, we already know there's somebody on one side of the position who's willing to take, for various reasons, political or non-political, to take certain positions over a long run that offer the markets on the other side an opportunity for return. In short, markets trend. They trend intraday, they trend for maybe 2 or 3 days in certain market environments, and they may even counter-trend based on who the participant is. Proprietary traders, at the end of the day, firms under new risk balance management, under value at risk, have to rebalance their book. You know at the end of the day darn well they got to reposition themselves. Markets have unique daily, intraday, and even longer market positions. Not all markets, not in all conditions, but we certainly do know that they offer those particular unique environments. Most important, that these particular unique market environments quite often offer you the return process in exactly those markets where the traditional assets do not offer you those asset vehicles. Classic example. When you buy stocks in many vehicles, essentially what you're doing, okay, is selling volatility. So as the volatility goes down, you make money. Right? Risk goes down, stock market goes up. In other markets where volatility increases, are there strategies that can offer you return in just those market environments? Yeah, there are. Straddles, various option-based strategies, okay, and various trend-following strategies or other investment vehicles that offer you the opportunity to do this. It can be long when the market's going up, it can be short when the market's going down. Essentially, there's your hint. I said I wasn't going to do a hand puppet, but this is my hand puppet story, okay? You need traders that give you this. Do they make money in all markets? No. There's been any option when the markets are flat, when the markets are relatively in stasis, okay, you're going to pay as you do for an option a little bit of a cost. But I'll guarantee you, my last minute here, we kind of view it like this. Why do you want to be in managed futures? Essentially, I always try to point out to people, it's like hiring the lawyers group here. It's like putting a lawyer on the street corner. There's a lot of days that you know there's never going to be an accident. Why do you put a lawyer there? You put a lawyer there because I tell you the truth, when if there's an accident there, you want to be there. Because that's when you make your money. So how do you lever the position? When you range, you put 2 lawyers there. Okay. So essentially, managed futures offer you the opportunity to make money in those unique market environments where that rain hits, right? Where those trends take place. And we do know those trends exist. I have a web page. If you want to take a look at it afterwards, we'll pass it around to you, where we do a lot of the research at the center. All of it is available. It's free. Ooh, that gives you a sense of the quality of it. Hey, it's academic land. Folks, you pay your taxes, you got to get something out of it. Right? Maybe some of you will even join the center. I think the people here. That is my pleasure. Let me go through a couple quick myths here that you'll see. I just wanted to get these out here because there are a lot of myths about managed futures. One, managed futures are not riskier than traditional stock investments. Quickly knock them off as fast as I can here. The average CTA is no more risky than the average stock in the Dow Jones. Simply not true. Average CTA has a volatility about 25% a year, about the same as the average stock in the Dow Jones. Average CTA is not more volatile than the average stock. Portfolio CTA is exactly the same annual volatility as the portfolio stock. Exactly the same, about 15%. CTAs are not more volatile on an individual basis, and they're not more volatile in a portfolio. Performance persistence exists for CTAs. They make money in this market. They'll make money in the next market when those market environments give you the return process. Benchmark indices exist for stocks and bonds. Benchmark indices exist for commodity trading advisors. We know how they perform. We know when they perform. Style analysis works for stocks and bonds. Style analysis works for commodity trading advisors and non-traditional assets. One can go on and on. And all of this comes down to the great statement, kind of like a nectarine, right? It's a wonderful fruit. Yeah, no, it's fruit. Academics are finally on board. They're getting a greater appreciation for these assets, a greater appreciation for when they make money, when they lose money. They spend time in markets, they certainly don't perform well, as other assets should not perform well in certain markets. But as in most things, a meal is not complete unless you have a wide variety of assets, each one of them in front of you, that offers you the chance to enjoy something in various market environments. And managed futures, certainly from an academic perspective, do that. It is now a complete fallacy, a common fallacy, and unfortunately a somewhat, fallacies are so if people believe in them, that's why we talk about them a lot, that managed futures or CTAs don't offer you, due to their unique trading styles, over the long run, an opportunity to make money, as long as future markets have the kinds of trends in proper market intervention, the kinds of events that have happened for the last 20, 30 years. If you believe the future is going to have actors just like it's had the last 20 years, managed futures give you an opportunity for making returns in unique market environments that are simply not obtained through many traditional asset vehicles. That's the story from academic field.
Yeah, I think we'll
Thanks. Well, I felt pretty good when Tom said I was a rubric alternative. But then he compared me to a soggy lawyer, so.
Still.
Long ago and far away, I was on the road coming to an event just like this, and I said, I think I'll entitle my remarks, 3 Impossible Things Before Breakfast, as in Alice in Wonderland and trying to believe 3 impossible things before breakfast. So as they sped me through the golden arches to get me breakfast, and dissuaded me that I needed to say that, I said, okay, how about 1 impossible thing before lunch? And unfortunately, we were going by more golden arches, and I saw them wanting to veer that way again. I said, we have to talk about this. I said, well, and this is how I've entitled my remarks ever since, how about 1 mildly improbable thing way before dinner? So, let me try 1 mildly improbable idea on you. A lot of people's thinking about CTAs revolves around risk. And my mildly improbable idea I'd like to take a whack at is that the best way to control risk is to take more risk. First, let me go through a few things that I think are bad ways to measure risk that a lot of people employ. 1 is worrying too much about the risk on individual trades or in individual markets at any given time. A lot of people will call me and say, what was your best position last month, last week, last year? What was your worst? What's the most you've ever made in a position? What's the most you've ever lost? And the true answer is I don't know and I don't care. If Bill Clinton were my advisor, he'd be telling me it's the portfolio, stupid. Really, it is. What happened last year is too small a statistical sample to tell you anything about what to do next year in any individual market. At Dennis Trading Group, we probably generate 2,000 individual trades a year. The risk on each one of them fairly minuscule, but collectively obviously fairly large. I'm so prejudiced against making decisions based on very short-term real-world results that I've certainly canned markets because of liquidity considerations after we made huge profits and kept markets on for years and years where the trades haven't worked at all. I think you have to have a theoretical paradigm to inform your trading. that doesn't have very much to do in the very short run with the real world results in any individual market. Many times I'll know what our largest position is and know that it's not so good and call the office and say, how are we doing? And I'll be surprised to find out our results are directly the opposite of that position. So not even your largest position in a sufficiently diversified portfolio makes that much difference much of the time. So controlling risk intensely by individual trade or market results outside the whole portfolio concept is not a good way to control risk. There are some ways to control risk that at least deal with the portfolio that it seemed to me fall short of the mark also. A lot of people ask about margin use, how much you use, what's your maximum, what's your average. At Dennis Trading Group, we probably average about 25% margin use. My guess is the industry average is more like 20. But our extra use comes from positions that are largely taken because they reduce the drawdowns in our portfolio. So that are we taking on more risk because our average margin use is 25%, and 10% of that 25 is deliberately created to make drawdowns less? I don't think so. So you can't just look at margin use by itself. Margin use by itself, I suppose, is somewhat related to another concept which I dislike equally, which is value at risk, which is a measurement if every position went against a standard deviation of 2 or whatever, how much would you lose? That too plainly ignores the correlations in your portfolio and the deliberate anti-correlations that you might create. At Dennis Trading Group, we found no correlation between our margin use and our large daily net changes, weekly net changes, monthly net changes, drawdowns, anything. Kind of an empirical validation of the idea that margin use rules aren't the ticker. Another portfolio rule that I find lacking is worrying about large daily results. Obviously, an excessively large daily result might be an example of bad risk control. But in the absence of something outlandish, it seems to me large daily results don't have to have any necessary relation to overall drawdowns. You could have a losing strategy with low daily variance, a strategy that has negative expectation. The probability, your maximum drawdown there, if you trade that long enough, will be 100%, even if you only lose a 0.5% maximum a day. A winning strategy of moderate variance trading in approximately, say, 20 independent markets won't increase its maximum drawdown if you can add 20 additional markets that are totally independent. For example, if the worst drawdown in a 20 market set is 3% in any given day, then if you double the number of markets you trade and they're independent, the worst drawdown in any given day will be twice that, 6%. But at the end of the day, you're no more likely, I shouldn't say no more likely, you're only trivially more likely to have a maximum drawdown in the long run, any larger trading the 40 market set than the 20. Even though the worst daily result could be -6 instead of -3, the maximum drawdown won't be hardly any different if you're adding independence. And more perhaps as a statistician would say, if you flip 50 points today and 50 tomorrow, or it doesn't make any difference relative to flipping all 100 points today, you won't get significantly more bad runs if you flip all those points today, even if you flip twice as many today as you would otherwise. So I go through the ways that a lot of people think about controlling risk and find them wanting, and come to the belief that the best way, by far the best way, to control risk
is to add risk, if you like, trades. I like to think of it as adding expectation to systems. I guess I could have said this in a less controversial way. If you've got a solid theoretical model of your worst case drawdown, in our case, in a 5-year track record, a little more than 25%, and a rate of return over that period of time, which is about 43%, you have a ratio between your return and your worst drawdown. In our case, it's about 1 2/3 to 1. To the extent you can improve that just by adding better trades, making your system better, that's the way to control risk. Change that ratio, make it as good as you can, and then you can lower the drawdown without lessening your return just by having a better ratio between risk and reward. I should just maybe mention for a second, if this is of any interest, what we try to do to push that ratio to be as good as it can. We take many conceptually different trend following approaches. We probably have 10 to 20 different systems doing about 60% of our trading in a trend following direction. We have 5 to 10 counter trend systems specifically designed to blend optimally with our trend following systems. That equals about 20% of our trading. And we trade stock index systems in a counter trend fashion, specifically blended with the rest of the above, which represents another 20% of our commitment. So our systems round out in total to about 60% trend following and 40% counter trend. At the end of the day, the only reasonable question, it seems to me, other than can you make your systems have that risk-reward ratio as good as possible, is what about Armageddon? What about the things that never happen in your track record and your research? First thing is, most all decent traders learn they cut back when they lose. They try to trade proportionally to their equity swings. And I think, although what we do is 99.9% mechanical, if you see an outsized result that you've never seen before on a daily basis, or more significantly, a worst-case drawdown, I think the way to avoid an unprecedented scenario is just to make sure that your cutbacks are faster than your equity decreases. That, it seems to me, virtually guarantees that even in a worst-case scenario, that you won't capsize, and when the situation returns to normal, you can assume your normal risk-to-reward ratio. Let me say one other thing before I give way to hopefully questions and answers to build on what Vern said. Another theory, not certainly incongruent with his, about how exactly systematic trading adds value. And this is from the point of view of somebody who has no inside information, no fundamental information, no ability to analyze fundamentals whatsoever. We know that prices trend, and I mean that in a technical, statistical sense, that if you just look at prices when they're in motion, they have a very small statistical tendency to stay in motion. Perhaps a market that's trending is mispriced at any given time by 1/10 of 1% of its price. Now, that mispricing, the trends are being caused by unknown information. Could be fundamental information, could be the information about what a government's going to do that might be accessible to some few people. But whatever that information is, the form of it and how it hits markets is always prices move, that information is divulged. The information gets into the price series before it gets into the newspaper. Systems are formulated to take advantage of this basic inefficiency. It's important to use adjunct concepts like diversification, volatility, and cost minimization. But at the end of the day, markets are always in their price exhibiting more information than what's publicly known. Let me just give you one example. It's from my old reprobate grain trading past. In 1972, for no apparent reason, wheat prices started up very slowly. They had been in a very narrow range between $1.40 and $1.50 a bushel for a year. And they got to $1.55 or $1.60, and that was a big deal. And no one could figure out why. And then they got to $1.70, and it made even less sense. Well, in a way, when I used to trade by my wits rather than by my computer, after this whole scenario played out, I decided that the more I didn't understand the trend, the more valid it was. Because at the end of the day, this was what became called the Great Russian Grain Robbery, where they managed to come in and buy a quarter of the wheat crop before anybody knew. And it's not, if we can personify the market, it's not quite right to say that nobody knew, because the price sure knew before anyone else. Now there's an example of information that's not even really inside information. It's just the way the world works. Sometimes there are market forces that have to operate over a period of time, and they can be operating with perfect secrecy, except to the market price series. There is no way that that information doesn't get into the price series. A technical analyst will predict 10 out of every 3 trends, admittedly, but that is the form of the inefficiency, in my view, that lets us construct systems, sophisticated versions of the primary principles that prices move before information is disseminated. So let me stop at that point and see what your appetite is.
Possible that a portion of that is attributable to attrition, meaning that
absolutely.
the guys that lose just fall out of the mix, and the guys that win obviously.
No, I think that's absolutely correct. I mean, if you look at the number of CTAs out there, I don't remember the number, but I think the largest is, they classify themselves as true CTAs. Trend following is probably us, and the smallest has $120,000 worth of assets, and I think that bottom turns over a lot.
Mm-hmm.
So if you look at it from an index standpoint, like any other, if you're looking at the index from the MAR index or the Hedge index, you're going to get that fundamental survivorship bias that exists in basically, all indices that are based on return. I mean, venture capital, there's no real venture capital in this index, but there's a poll of what venture capitalists do. You have the same survivorship bias there. Real estate with the Neckridge index, you have the same kind of bias that fundamentally exists within the index reporting. I think the counterpoint to that, of course, is that you look at the largest traders that have been, and there's certain traders that have been in existence for a long period of time, John Henry being one, Dennis Trading being another, Chesapeake and Campbell. I mean, there are a few large people out there that have been around for a long period of time that have had positive returns over long periods of time and have a pretty consistent return parameters to them in terms of when they do well and when they don't do well.
Well, could you say that's skill-based? I mean, there's a lot of painters, but there's a few Picassos and Miros and Renoirs. I mean, you're talking about the best guys of the mix, and really the key is to find the guys with the skill.
I think a certain portion is skill-based. I don't think it's all skill-based, because as Richard says, it's we have models, and we mix the models in different ways, and he has a different model than John Henry has, and he mixes it in different ways than John Henry mixes it. But there has to be, the fundamental question, thinking about it as an asset class, right, is you can't really have a skill-based asset class, right, because it doesn't really exist in perpetuity. It exists until, Richard stops trading or John Henry stops trading, or so if you think of it from the standpoint of an asset class, there has to be something else there other than...
But is it right to think of it as an asset class? I mean, that actually brings me to my other question. How do you benchmark?
It is, to the extent that I can tell, I know Richard, I know his data sets, I know John Henry. I can tell you beforehand whether you make money or lose money almost 95% of the time, because I cannot stop. I know the market environment that it is, and they will make money or they will lose money in that particular market environment if they keep constant to their strategy. The reason we remove managers is the same way we remove traditional managers. If they make money in markets they shouldn't be making, or if they lose money in markets they should be making it in, that's when they're not following their strategy.
But how do you benchmark a guy? In other words, everybody is so individual, and it's not like being a mutual fund manager where you're based upon the stock market.
No, John. In truth, if you take the traditional manager, one of the fallacies, good diversification, bad diversification. You can take traditional managers in certain markets that have zero correlation. Now, let's get right into one of these things. A lot of markets are noise, right? Zero correlation. You can't trust historical correlations over all periods. Lead with that concept. Good diversification, bad diversification. Most stocks have bad diversification. They all go up together and they all go down together, even if they have a low correlation amongst themselves. So you can't look at historical correlations. But what you can say, stock market goes up more than 1 or 2%, 95% of all mutual funds go up, and 95% of all equity mutual funds go down. Bingo. Okay? At the extremes, they all go up and they all go down together. But on most days, not much happens. Same thing with commodity trading advisors under a particular strategy. Guarantee you get a 2% movement of a certain kind of market environment. 78% of 60 to 70% of all CTAs who trade that strategy, they all go up together and they all lose money in the same kind of market. Why? Because the fundamental strategy they have captures particular market environments. Do we have passive indices that replicate that? Yes, we do. BNP has them. We've got them. We can get passive strategies that capture about 80% of the MAR CTA active manager benchmark index, just like the S&P captures maybe 80-90% of the mutual fund benchmark. Is there skill around that natural return? Yes. Some individual stock manager, you buy an index, you write it up, you write it down. What do you hope from a skill-based traditional manager? When the stock market's going down, right, protects you on some of the downside. Give up some of the upside, protects you on the downside. Likewise with excellent commodity trading advisors. You have a natural benchmark, but you don't write it up and you write it down. That's a passive index. You buy individual skill people that when the passive index starts going down, they can either reweight, leverage, watch their drawdown, the risk management, and they'll give you the same kind of thing relative to a passive benchmark commodity trading advisors, the same way that a long-only manager will give you that relative to a passive stock index. Exactly the same.
I think what you're saying is true, but you really can only look at managers like Mr. Dennis and John Henry that have a long track record, because most of the guys, in fact, I'm a CTA myself, so I'm not trying to badmouth CTAs, but most people have a short track record, and as Mr. Dennis said before, it's not really statistically relevant sample. I mean, a guy can make money for 2 years, and does that necessarily mean he's going to make money on the third year? You know, a person with 10 or 20 years, yeah, maybe you can lay it out statistically, better than you can with a guy with a new track record.
You tell me your strategy. I don't give it hours. 1 year, 2 years. You tell me your strategy. Give me daily data. I'll guarantee you would have lost money in March '94 even if you weren't there. You would have won money in 1987 given that strategy. You don't have to go back 10 years to tell me whether you would have made money or lost money in that strategy. You give me the strategy, just like the traditional long only. And we know when you're going to make money, and we're going to know when you're going to lose it.
You heard it here first, folks.
Follow on to the point Tom is making. If he's successful in convincing all of my friends who run big pension funds that this is a legitimate asset class that they should invest in, what impact is the capacity issue? What could we look for if there were hundreds of millions of dollars that flows into this asset class?
Let me answer that. Yeah, obviously that is an issue, and I think it's something that continues to need to be monitored in terms of the overall capacity that exists in the market. If you look at the number of CTAs, I think in the CTA universe in 1988 was about $3 billion, right? The number now, at least the published number, is about $35 billion. Now, in the meantime, the hedge fund industry has grown from about $30 billion to about $360 billion before last quarter. And so, I think you have to look at capacity on two levels. One, you have to look at capacity as the amount of money devoted to to the CTA business, trend following CTA, and secondly, you have to look at the amount of money that's devoted to the market in total. And clearly, because our strategy, unlike many hedge funds that got beaten in the third quarter, we're not particularly concerned about liquidity. Our strategy, most CTA strategies, are extraordinarily dependent on liquidity. And so the industry cannot absorb, I believe, the industry cannot absorb huge amounts of additional capital that comes in. And we all, hopefully, every CTA out there has some view on what the capacity is for their own performance. Now, that doesn't mean the whole industry can't get overwhelmed, just as the hedge fund industry got overwhelmed with the same, with the huge amounts of growth of assets, the huge growth of leverage, and basically everybody having the same damn trade on, or the same damn 10 trades on. And so I think it's something we have to be all very concerned about.
As a follow-up to that question, have you seen any degradation in your skid factors over the past 2 years?
We have not, no. And part of it is we continue to look for ways to make sure that we add additional capacity through, one thing, for instance, is going to a 24-hour trading desk, and which provides opportunities in other markets, diversification among the markets that we trade as liquidity develops in specific futures markets. Also looking at newer technology, the swap market, for instance, as a potential to find other ways of adding liquidity, not adding diversified liquidity as ways of doing it. But it's a very great concern that I think that we have, and we monitor our slippage on every trade every day. And so our slippage has actually decreased over the last 2 years, but I think that's a result of in making major investment in more traders and more markets.
One other thing, I don't want to sound too much like a supply sider, but I've noticed in my whole career that the demand for liquidity kind of creates it. That markets that I thought would never bear the traffic now bear considerable traffic volume just because there's a demand to trade them. It makes some sense. You create markets where people can make some profits, sort of getting in between the bid and offer in markets that everyone thought were useless before. And any CTA with experience probably spends half their time worrying about skid. It's probably, once you know what to do, it's just how to do it is the most serious issue. And I've been surprised in a way how little difference sort of that inequity makes, considering a priori how much difference you would think.
Notwithstanding what was said before, this is a question for Tom. Does size matter?
Size of the firm matter?
Size always matters.
Yes. I think it's a very detailed argument, and I agree with the comments here. First of all, remember the futures markets price off the cash market quickly, and I'll tell you the truth, as more volume, if you believe that volume in the futures markets causes prices to start rising above the true value, I'll guarantee this cost to carry model in there that will bring it back into line. The fundamental pricing futures markets always tracks the fundamental cash market. So futures market, while they had some volume concerns as you approach delivery, increased volume in futures market will always drive an opposite position if in fact it moves away largely from a very large arbitrage position. Does size make a difference? And this is from putting on my, not taking my academic hat off, putting on my other hat quickly here. For firms like John Henry and the like, they have to trade certain markets because of their size. Nothing wrong with that. And I say for some of the people that might want to talk to smaller traders, let me say one of the benefits of a smaller, one of the advantages of that, by the way, also, when you have the size of John Henry, Richard Dennis, you can trade many, many markets and have the opportunity to garner the trends that exist in all of those markets. Well, that's one of the advantages of size. One of the disadvantages of size is that, as they pointed out, you have to be very careful that you don't become the market. And smaller firms that concentrate on individual markets, while they don't have sometimes the diversification by trading multiple markets around the world because they only have 20, 30, 40 million in management, they do have an opportunity to pick and choose their positions. So especially those CTAs that have more market neutral, mean reverting, arbitrage kind of processes certainly can benefit from being small. They know when they can trade, how they can trade, they pick and choose their moments that they move into the market. So as in most things in life, there's advantages to large size and advantages to small size. You have to look at the individual trader, you have to know what the strategy is, and why that particular size is effective with that particular strategy. Once that, it's like anything else, you can make good money.
Any guys believe that commodity size and going to reverse this time?
Well, I'm not speaking ex cathedra here. This is not one of my specialties, fundamentals. But I think you can make a case that we're reversing what happened about 25 years ago, and the commodity prices might not ever reverse. I think the cost of production in a lot of these commodities is more dependent on production in international areas where the cost of production is a lot lower. I'm not a fundamentalist. I'd like to know what the cost of production is for soybean in Brazil, but I think that's the price we're going to wind up at. There's a few other more technical arguments why commodity prices should be lower, better inventory management, things like that are a result of high tech. This will probably be the absolute low, and I'll look very bad 10 years ago if any of you remember this. But I think there's a case to be made that that we've reversed a very long cycle, and that we might be on a very long cycle in the other direction.
Question for Richard and Vern. Suppose I'm an investor now with a traditionally balanced portfolio, and I buy into the arguments. You convince me that it's right for me to make an allocation of managed futures. What advice would you give me? How would you like to see me implement a strategy relative to the balance of my portfolio?
Well, you sure should diversify. I think that you don't have to do 10 different advisors, but 3 to 5. I mean, probably would be a good idea. Other than that, I think the most primary thing is to listen to the rationale. I hate to say it with all these statistics running around and that, but that if you don't buy the rationale behind what the people are doing who you're giving the money to, you shouldn't do it. For no other reason than you won't stick with it when things get tough, as they inevitably will in any investment if you don't believe in the underlying rationale. So I would say diversified, fully informed investment that believes in it enough to ride some bad things out.
I don't disagree. I mean, when we look at it, it's interesting if you plug it into an optimizer, right? And it depends on what you assume the expected return of managed futures is and what you expect the return of stocks to be. And clearly the correlation of zero or close to zero for most managed futures advisors and a positive return, that relates to the volatility. So kind of you expect the volatility is relatively close to the stock market, so expect the same type of return you'd expect on stocks. I mean, that's using capital pricing line. You'd say it would get pretty close to 50-50 in terms of what your allocation would be, just from a theoretical basis. Of course, I'm not proposing that you should follow necessarily the optimizer in this case. I mean, I think Richard makes a good point. In generally, what we propose to people in terms of looking at diversifying your portfolio, which consists of stocks and bonds, is between 5 and 10%. That is a large enough allocation to managed futures to create a difference in the return profile of the portfolio. You probably should start at 5 and move to 10 as you get more comfortable with it. But basically, based on history, is if you decide that you can't stand the pain, right, and get out, that's probably the bottom of the market. I mean, that's just the way. It's just like the stocks, and that's the biggest risk I think that anyone has in any portfolio management scenario, is that you don't stick with it long enough. And small cap stocks or real estate or venture capital or the GSCI index or managed futures, if you can't stick with it for long term and can't stand the pain, then you shouldn't be in it at all, and you should be in something that you can understand and stand the pain.
Final point, there's a CIC and educate. We have a piece called Asset Allocation in Institutional Portfolio. I agree with Vern. After you break in stocks, with 40% stocks, 40% bonds, some high yield, put your venture capital in there, put your real estate there, put your commodity, after put all those things into your portfolio. Even after you do that, managed futures still will dramatically increase the Sharpe ratio of the portfolio when you have 2 to 5% invested inside commodity trading advisors. These are portfolio. So the 50-50 says you're just adding to strictly stocks. If you have the typical portfolio, 50-60% stocks, bonds, commodities, venture capital, hedge funds, all those already in your portfolio, commodity trading advisors, because they don't have the same drivers as all those other things, still about 2 to 5% improves the return risk ratio of your portfolio by adding them about 2 to 5%.
It's interesting because when we did the model at Harvard, we used the GSCI, as basically one of the main diversifiers. The model just loved it, even though the expected return of the GSCI is a lot less than the CTA would be based on history and volatility, and doesn't really sit on the capital pricing line. But the diversification aspect, the optimizer just loves it, and they would have owned basically 50% venture capital and 50% commodities if it could have. I mean, if we wouldn't put all the restrictions in it. And the fact is that it was a good thing for Harvard that it kept down the GFCI exposure based on the performance of the last year or two.
I think on that note, we're going to wrap it up. Steve, you have some concluding remarks for us?
Yeah, good. Thank you. For those of you who think that we've been getting some great speakers, and partially that's attributable to you. I'd like to thank specifically this panel for helping us arrange this panel. Ken Sher, thank you very much. And also Juan Mayer. Without it, we wouldn't get great talent to enlighten us. But more specifically, and probably more importantly, is this venue that we've been able to hold our meetings in. And when we started a couple of years ago, it was with the help of the Hasco family that we were able to meet in the States. You'll notice around you the artwork in the room is once again Norman Hasco's collection, and I think we owe him and family a round of applause. And I'd like to say thank you to the Hasco family for making this all possible.
Well, we started talking about the art around the room. We finished talking about the art around the room. I want to thank the panelists for taking us from the abstract to the concrete in this field of futures, and we thank you all.